Hello everyone, and welcome to our latest market analysis. Today, we have an extremely practical guide. What is the ultimate goal here? It is to turn dry, messy chart data into a crystal clear story about the battle between buyers and sellers. Once you can truly read that story, you will hold the key to identifying trading opportunities with a very high probability of success. Let's get started. Let's see what we have today. We will quickly go through 5 core sections: where Japanese candlesticks come from, the battle between supply and demand, practical candlestick patterns, combining candlesticks with trend lines, and the essential final part: stop loss and take profit. Let's go straight into part 1. Where do Japanese candlesticks come from? Basically, Japanese candlesticks are simply a way for us to visualize the price history of an asset over a specific period of time. That means if you open a daily chart, each candlestick summarizes everything that happened to the price during that entire day. Think of the market like a giant tug-of-war contest. On the chart, you will mainly see 2 types of candles. A green candle appears when the closing price is higher than the opening price. This confirms that the buyers have pulled harder and beaten the sellers. On the other hand, a red candle appears when the closing price is pushed lower than the opening price. This shows that the sellers have completely overpowered the buyers and forced them into a clear defeat. This is the most basic binary principle that we must understand firmly. All right, let's move to part 2, the battle between supply and demand. Now we are going to break down the structure of a candlestick to understand the psychology behind this tug of war. Trust me, these are not just meaningless colored blocks. They are traces of human psychology. When you look at the shape of a candlestick, the size of the candle body tells you about strength. The bigger the body, the more one side is completely controlling the game. But what if the candle body is tiny? That shows intense hesitation and struggle. Neither side is truly in control. But the most interesting part lies in the wicks. What does a very long upper wick tell us? It means selling pressure is extremely strong at higher prices. The buyers tried their best to push the price up, but they ran straight into a wall of resistance and were knocked back down. Similarly, a long lower wick is clear evidence that buying pressure is waiting below. The sellers tried to push the price deep down, but they completely failed. Now let's move to part 3, practical candlestick patterns. The key question here is, how do we take these psychological clues from the tug-of-war and turn them into real trading signals? First, let's talk about the doji candle. You can think of it as the market's pause button. The opening and closing prices are almost exactly the same, leaving behind a tiny candle body between 2 long wicks. A single doji candle by itself does not tell us the next trend. It only shows that both sides are fighting intensely. But here is the important point. If you see a series of doji candles appearing one after another, that is a sign that the market is compressing energy, and a strong breakout could happen very soon. Next is one of the most powerful patterns, the pin bar. Let's take the bullish pin bar as an example. This is a bullish reversal candle. It has a small body and a very long lower wick. What story does it tell? It tells us that the sellers rushed in and pushed the price all the way down, but then the buyers suddenly fought back aggressively and drove the price back up. A bearish pin bar is the opposite. A small body with a long upper wick. That long wick is visual proof that one side attacked aggressively, but was crushed almost immediately. When you see these candles appear at the end of a trend, you should prepare for a possible reversal. We also have more complex candlestick combinations made up of 2 or 3 candles, such as the engulfing pattern. This pattern appears when the second candle is large enough to completely swallow the previous candle. It is a sign that the opposing side has seized control. Then we have 3 candle patterns, such as the morning star, which signals a bullish reversal, and the evening star, which signals a bearish reversal. You can imagine them like a 3-act play. Act 1. One side is dominating. Act 2. A doji or pin bar appears, showing hesitation. Act 3. Boom, a huge candle appears, confirming that the entire situation has completely reversed. At this point, you are probably wondering, how do we actually trade these patterns? Clearly, we cannot just see a candlestick pattern, close our eyes, and jump into the market. That is far too risky. We need a more practical and applicable method. And this is where part 4 shines, combining candlestick patterns with trend lines. This is the heart of today's strategy. We are going to take the psychology of candlesticks and connect it tightly with the bigger picture of price action. There is one golden rule that every professional trader knows. A single candle has no meaning by itself. You must combine it with price action. Seriously, even if you spot a perfect Morningstar pattern, but it is floating randomly in the middle of the chart, it is basically useless. These patterns must appear at meaningful structural areas, such as support, resistance, or a clear trend line. Let me show you a simple 4-step execution plan that you can copy immediately. Step 1. Start by drawing your trend lines and clearly identifying support and resistance zones. Step 2. Patiently wait for the price to approach these boundaries. Then observe whether any confirmation pattern appears, such as a doji, pin bar, or engulfing candle. Step 3. Place your order. If you are buying, place the entry just above the high of the confirmation candle. If you are selling, place the entry just below the low of that candle. Step 4. Set your take profit and stop loss. If you neglect step 4, you can lose everything. So now we move directly to part 5, stop loss and take profit. This is your only shield against the unpredictability of the market. Look closely. This is the formula that protects your account. For a buy trade, place your stop loss immediately below the lowest wick of the signal candle, such as a pin bar. Your take profit target should be the nearest resistance level. On the other hand, for a sell trade, place your stop loss just above the highest wick of the signal candle and aim for the nearest support level as your take profit target. Can you see the tight logic here? If the price moves against you and breaks through the wick of the signal candle, it means the psychological pattern we expected was wrong. The side we thought had won actually lost. That trade is no longer valid, and we must exit immediately. So now we have put all the pieces together. Our complete trading system is not just about candlesticks. It is an equation. Candlesticks plus price action plus risk management equals high probability trading opportunities. You truly need all 3 elements if you want to survive and win in the market. Before we wrap up, I have a question for you. Are you ready to stop blindly guessing and start truly reading the story of the market through every candlestick? Of course you are. The next time you open a chart, look for these tug-of-war battles at key price zones and apply this step-by-step system. Thank you for watching, and I'll see you again in the next exciting market analysis.